right, welcome to the Big Skinny with Lou Basenese. That's me coming to you after the markets are rip-roaring higher because the Fed cut rates. And guess what? We got that one right, but so did everyone else and their mom on this market here. We knew what was going to happen if speculative assets taking a turn higher, rocketing higher, and we're going to bring you some more investments to take a look at because, well, first let's get to what we're all about. You're probably wondering if this is your first time joining the Big Skinny. Let me tell you, well, Urban Dictionary defines the Big Skinny as insider information. We are absolutely not that. We don't like getting arrested for felonies, but it goes on to say that is the essential information, the market truths that matter, and that's what we are definitively about. We want to bring you some actionable information in all the overwhelming noise and clutter that comes in the market. So many headlines thrown at you, so many email newsletters thrown at you, so many misinformation. We want to sort through all of that and give you the bottom line things that matter and that can improve your bottom line. Because after all, if we don't make money together, what are we doing here, right? Well, we do this all in a very predictable format. We give you one headline, one chart, and one action to take for 3 of the top headlines each week. We call that our rundown. Along the way, we allow you to join the conversation because we're streaming on multiple social platforms. So there's always an unpredictability about what we might talk about each week. The other thing that is always about us, and we'll share more on our manifesto later today, is that we know we have to be humble in these markets or we're going to be humbled by them. So we always bring on a guest that helps level up our game. And today I'm excited, without any technical difficulties, we're going to have a great interview with Eric Jackson, the president of EMJ Capital. And this man's life, I will tell you, and we'll get into it, has dramatically changed in the last 10 to 12 weeks as he has really just done an amazing job of marshaling the collective power of self-directed. I'm not going to say retail investors, not dumb money, of self-directed investors to catalyze change at public companies. We will look back in time and this will be a historic moment led and catalyzed by the leader of the Open Army, Eric Jackson. So excited for that. Before we get there, before we get to our rundown, I want to encourage you to make sure you follow us on socials, whether it's on YouTube or Twitter. You know, Mr. Beast might follow us. Well, we'll never get to his just mass celebrity fame, but just give us a follow. We're just trying to catch him, maybe to catch up with him. So if you're watching us on YouTube, go ahead and smash that subscribe button. If you're on an X, go ahead and click that follow button. You don't want to miss the content we bring because it's not just about us, it's about you and improving your bottom line, like I said. So with that in mind, let's get to this week's rundown. All right, remember, this is the 3 biggest things that matter in the markets, and we're talking about real estate to start, which might be a shocker to you. Is it a real problem? A lot of people have said the Fed cut is really the silver bullet for real estate. It's what we've needed to get this market where there's buyers just sitting on their hands and sellers lowering their prices. Just get it out of neutral, right? And Realtor.com with this catchy one, the godfather of financial independence calls buying a house a silly investment for young people. He's wrong. No, he's not. He's absolutely right. Obviously, these experts that they spoke to that are in the real estate industry are always going to tell you it's a great time to buy real estate. But I'm here to tell you, real estate's a great inflation hedge. It used to be a great way to potentially increase your wealth in younger years, but prices, affordability have gotten completely out of whack. But here's the funny thing. Most Americans still think real estate is the best way to grow wealth. A recent poll that came out from Gallup shows which of the following ways do you think is the best long-term investment? Here you go, chart topper, real estate at 37%. Stocks and mutual funds in the middle of the mix there, and bonds, thankfully, down at the bottom. Shocker though, crypto at the bottom. So that gives me some just contrarian optimism that crypto's got a lot longer of a bull run ahead of it because people just aren't thinking about it. So when everyone thinks alike, everyone's likely to be wrong. And I'm here to tell you, if you're a younger person or middle-aged or just getting started in wealth creation because you've been busting your chops in a blue-collar job and now got some extra coin and you want to put it to work, real estate's not your choice. It should be the stock market. And we want to talk about this, and here's why. I think there's way more opportunities in the stock market right now than there is in the real estate market. Let's pull up this week's money chart for the real estate problem, and it's a real money pit. I mean, look at prices and look at what we've seen. I mean, if you ever saw the movie The Money Pit, you know that real estate involves a lot more than just the purchase price, which is the purchase prices have gone bonkers. I mean, we're over the 2006 bubble that had a massive correction. We're now in the 2025 bubble. And despite the headlines that might tell you you can earn 12 to 30% average annual returns in your real estate holdings, those are gross returns. They don't take into account all the expenses that come in with home ownership. I'm talking about things like HOA fees, insurance, maintenance, everything. When your wife puts too much asparagus down the garbage disposal and it breaks and you got to replace that, it's endless. As someone that's owned too much real estate and bought and sold it and now living in New York, it's renting, I'm happy. I get to call someone else and they have to incur the expense. So the investment takeaway is don't rush to own real estate if you're looking to build your wealth. There's other ways in this market, potential investments in stocks that are levered to real estate. We're going to talk about one of them, Open. Another one I came across recently at an individual investor summit that Eric Jackson and I were both at, that he headlined and I was in the audience, is AIRE. This is a company, AIRE, that is trying to disrupt and digitize all the services that are involved with real estate. So look, if you're eager to increase your wealth and you're eager to get involved with real estate, do it from the digital side in individual public companies that are levered to the real estate market, because there's no panacea here. A single interest rate cut is not going to reignite and send prices soaring higher. The buyers are still going to be very particular. All right, let's get to something that is surging. It's the small caps. Finally, I've been early, way early, and wrong on the small cap resurgence, folks, but I'm here to tell you, guess what? The headlines aren't always wrong. CNBC reporting here, the post-pause rate cuts have been a very good setup for small caps, history shows. What do they mean by post-pause? Well, they mean a long pause in between rate cuts, and that's what we've had. Now we finally got it, and it turns out that small caps historically perform very well in this environment, and that's exactly what we're seeing. The Russell 2000, the small cap index, broke out to new highs, new all-time highs for the first time in nearly 4 years. Now, this is actually happening as a rarity here. I mean, if you look at some quotes here from Dave Mazza, who's the CEO of Roundhill Investments and Financial. He was actually on the show before talking about some of their new ETFs. He pointed out what happened this past week that is truly rare is that this rally pulled all the major indexes to fresh highs, and that was lit, obviously, by the Fed rate cut, and it's really lit a fire under small caps, which has been left behind for years. Now, small caps, look at this. You don't even have to read the details here. You can see this is what's called a heat map. When it's green, it means these stocks are up. When it's red, it means they're down. This is the Russell 2000. There's nary a red dot on that screen. So folks, we're in rally mode all across the small cap sector. I fully expect this to continue for a few big reasons. One, small caps are traditionally domestically focused. So as the U.S. economy gets re-energized with the rate cut, these companies are going to do a lot better. Their earnings estimates are actually going to grow a lot faster than large caps. This year, small caps on average are going to have a negative earnings growth, but next year it flips positive to 18% growth, which well outpaces the S&P 500 in large caps. And then in 2027, it jumps to a whopping 37% earnings growth. Now, those are analyst estimates. They can always come down, but here's what I'll tell you. When earnings are growing that fast, and small caps are trading at 15 times forward earnings, cheap in other words, and large caps are at 22 to 30 times if you're looking at the Mag 7, this is a class, an asset class, a sector of the market that's going to do really well, especially because no one's allocated to it. Individual investors, based on the latest AAII survey, they were asked this following question: what are you favoring right now? Bottom of the list, small caps. Look, I said it before, when everyone thinks alike, everyone's likely wrong. They're wrong about not favoring small caps right now. Institutions, they're doing the same. Record short bets against small caps peaked at about 17 billion as the small cap Russell ETF went higher. So you're seeing this. Even the smart money has been caught on the wrong side. They're caught off sides with their pants down. They're going to have to buy to cover, and that's just going to lead this small cap rally a lot higher from here. And so, yeah, mama said knock you out, new highs. It took a long time, 967 days, nearly 4 years for the Russell 2000 to hit another all-time high. But folks, we've learned this from the S&P 500. All-time highs lead to more all-time highs. So we've got a long way to go. The easy way to get exposure? Buy the Russell 2000 ETF, IWM, folks. That's an easy way to make sure you're levered. And then listen into our show, because we focus a lot on compelling small cap opportunities. All right, rounding out the rundown is the Open Army. I really want to talk about how big of a deal and change this has been for everyone involved. The mainstream media and the financial press still wants to dismiss this as nothing but a meme stock. Mark Cuban himself is even out. This is a headline that we shared before from Forbes. Meme stocks are back and retail's about to get burned again. Sorry, folks, I don't think that's happening. It's even more so because here's why. There's more people engaged and active in these markets looking for good information and alpha. They're not just throwing money around in the casino and speculating wildly. They're actually looking for fundamental stories. So the Mark Cubans of the world who are billionaires already, and if you look at this wealth chart, are way in the 1% of the 1%, don't understand what those of us that are still in the bottom are trying to do. We're trying to increase our wealth. We're not in the top 1% of the 1%, the billionaire class. And the best way to do that is through the stock market. We have a record amount of holdings in 401ks in the public markets now. And folks, this is totally changing the game, much to traditional Wall Street's chagrin. But we're here to tell you it's a perfect time for us to get involved and embedded in these markets. And here's what I need to tell you. It's a changing of the guard. And there's going to be a huge wealth transfer that has huge implications for the traditional financial management world. So you see all the baby boomers and their wealth that is in the trillions of dollars. Eventually, that's going to pass down to Gen X and the millennials who are way more active in the markets now. They're going to be self-directed. They're going to go ahead and find these new opportunities on their own, and they're not going to pay exorbitant fees over time. They're going to find people that add alpha and understand what they're looking for, like Eric Jackson and his hedge fund. But it's not going to be just the traditional Wall Street complex. So I'm here to tell you, it's changing of the guard. We want to be on the forefront of it with you and along the way. So we'll be right back after this quick break to bring in a man that is helping others do just exactly what we're endeavoring to do. So stick with us.
Musk took the paddles out this morning. Shares of the EV company jumping after Elon bought 2.5 million shares for $1 billion. This is the first time Musk has purchased the stock in the open market since 2020. It's reportedly his largest purchase ever. And let me get this right this time. Tesla's up $23, almost 24. It's about a 6% move today on that cash infusion.
So what do you think he's saying, Lou?
Well, listen, Peter Lynch said it early. Insiders sell for a lot of reasons. They buy for only one. They think the price is going up. He's betting on himself. He's betting on the future of humanoid robots, on electrification, on storage. I've been a Tesla, let's say, pessimist because of valuation alone. I don't want to bet against Elon, though.
He's got
I'm not a bear.
Fair, though. I would just argue, is he doing this? Does he really believe it? Or is he doing it because he feels like the market needs to believe it?
Well, I mean, he could do that with, $500 million. $1 billion is a testament and a statement, loud and clear. We're headed higher from here. Market's starting to respond in that direction. All right, welcome back to the Big Skinny with me, Lou Basenese. I'm not going to lollygag around here because we don't have time to spare. I'm going to get right to it because the man of the hour, the man everyone wants to talk to recently is Eric Jackson, and for good reason. So let's welcome Eric Jackson back to the Big Skinny. Glad to have you again, my friend.
Great to see you, Lou.
Yeah, man, I don't know. I think you are the busiest man alive in terms of social engagements and podcast and media. So do you ever get a chance to catch your breath?
This weekend, I'm taking my girls to like an amusement park tomorrow with two of their friends. So yeah, that'll be fun.
Good for you. Look,
but it's been pretty busy.
Yeah, I want to give credit where credit's due, and we don't get any of this. But since you were on our show the first time, you mentioned IREN, Cipher, and Open, and they were, well, the last time we talked about this, Cipher was up 77%. This was as of September 5th. IREN was up 87%, and Open Door was up just over 1,000%. Fast forward a mere 10 days or so, and we're now looking at Cipher up almost 200%. Same, IREN's 150, and Open Door 1,729%. You got the hot hand, my friend. What is really driving these? So people will tell you this is meme stock mania. I want to hear it from you, who's done the work and the research. And we had Mike Alfred from IREN Board of Directors on last week talking about the moves there. But what do you see that's driving these stocks in particular? And then we'll get some Open Door.
Sure. Well, I mean, Mike is great, and he's one of the reasons why I got into IREN and Cipher. I was listening to one of his spaces, I think it was back in May, and so he's sort of he got me excited that the rest of the world would eventually see that there's not enough energy to power our desires to type into ChatGPT and use other AI applications, and so as the world kind of woke up to that fact, there would be a realization that players like IREN and Cipher, who've got the gigawatts actually coming online in the next 12 to 18 months would be in demand, and then they could sit back and be in the catbird seat to sign lucrative deals. And I think people have started waking up over these last 3 months to that reality. And then the Nebius deal just a couple of weeks ago now, that where they signed a deal with Microsoft that they would provide 1 gigawatt of AI data centers from New Jersey to them. That was worth $18 billion over the life of the contract for Microsoft.
Which is crazy.
Yeah.
I mean, if we applied that same multiple, right, or that rate per gigawatt, I mean, what does that do to your calculations for the value of an IREN or a Cipher? I mean,
it's like each of them have 3 gigawatts coming online in the next year, and they haven't yet to do that. And every month that goes by, the price seems to go up. So, I mean, I got into them both. IREN, I think, around in the 9s, and Cipher in the 3s, thinking that eventually they could each 100x. And I don't think it's going to happen, next year. But I think 3 years out, 4 years out, I mean, that's, you're talking about 900 for IREN, 300 for Cipher.
It's not hype. Like you said, they have about 3 gigawatts of power coming online in the next, call it 18 months each, not just one of them. You apply that same math where, let's make it easy round numbers, 20 billion for each gigawatt. I mean, that's 60 billion worth of market cap that should be ascribed to them on a simple 1x multiple. And things are crazy. I mean, IREN's at what, 10 billion market cap today as we look at it. So, it could have 6 times that in annual revenue secured for these gigawatts. So I think that's what separates this out from the meme stocks, right? Like if I look across, it's Jim Cramer.
It got up so much. I mean, like after Liberation Day, I mean, I think IREN got us under $6.
Yeah.
And how today that's knocking on the door for 40. And I think, one thing I see all the time with Open is that shareholders say, "Oh, I missed it. Oh, I missed the move from 6 to 40." Yeah. And yeah, sure, you missed it. Okay, that's fine. But you got to think about like this other math that you and I were just talking about. This 20 billion, deals times 3. That's a $60 billion deal that IREN could potentially announce. In the next little while. Like, what's that going to do to this $10 billion stock? I mean, it's going to be multiples more. And you should never feel just because you missed the first 10 or 20 or 50 or 100% of the move. I mean, you have to think of the bigger picture and where things are going. And both of these companies just have a phenomenal future in front of them.
Yeah, and I think, look, this is where I want to get your thoughts on this, because I think traditional financial media has a blind spot here, right? They're always looking at mega caps and large caps. So when they see moves like this, they just don't believe there's another 100x or 1000x left in the tank. So that, like, Jim Cramer's coming out calling this a meme stock. Mark Cuban. I mean, you go down the list, there's everyone saying that. But you and I look for alpha in the small and micro caps where they can make 1000% moves before they even get on the radar into the small cap, mid cap land. So, I mean, how do you educate some of your investors to the volatility that comes in this world, but then the opportunity? Like, what would be your encouragement? Is just like, how do you encourage people to be unafraid to buy when they've seen a big move?
Well, I mean, I'm like you, Lou. Like, I have been waiting for this small cap rally for probably, it feels like 2 years now. Okay.
Yes.
So, and I've been wrong, and when you're waiting and you're wrong, you're wrong. And so, like,
someone said to me, early has the same number of letters as wrong. And that's what I always use because it's true.
Yeah, so I understand why the Jim Cramers of the world have, it's safer to kind of sit back and just trust the Mag 7. I mean, these companies are like a bulletproof almost.
Yep.
And so, but you got to realize that when these smaller cap names move, they really move. And I think we have enough evidence now this year, like in, say, the last 6 months, that I think this move in the Russell is real. And usually, what you see when you go look back in history is that when you see a bigger move, like I think we've seen in the small caps, it doesn't just sort of go for 6 months and then immediately, cuts out. I mean, it's typically like, talking about a year to some, maybe 3 years that these names could run. And if they run, they really run,
Yes.
And you're not just like 10% a year, 30% a year. I'm talking like multiples, that they can grow, especially starting off of a small base.
Yeah.
So,
and it usually happens after like market dislocations, right? Because if I look back, Liberation Day started this one, right? Huge bounce off the bottom. Before that, it was the COVID lows, small caps and micro caps surged way ahead of large caps. And then you go back to the financial crisis, even the dot-com era. Like, it seems like these huge market and sudden dislocations always spark these multi-year rallies in small caps.
And I think like people, this is since the great financial crisis. Like so many people, especially on X or Twitter, they want to be the ones to be seen as smart in their little peer group or FinTwit group and call the end of the rally, right?
Right.
And so they everyone's like, it's not real and it's about to fall off a cliff and this is just another meme stock. It sort of goes with that thinking. I'll never forget. I went to China once. I think it was in 2010. So early 2010. So the market bottomed after the financial crisis, March 2009. We weren't even a year removed from the market bottom. And I gave some talk over in Beijing to this group of folks that were at like the Wall Street Journal bureau in Beijing. And they were convinced that the market was about to go to turn, fall out of bed again. And they couldn't believe this thing could rally for another year or two or three, let alone, I think it rallied basically until COVID, sort of 10 years.
Yeah, no, it was very long. Yeah. So and then that's a reminder, we've shown on the show before, kind of the average duration of a bear market versus the average duration of a bull market it's not even a comparison. Bear markets are like you blink and they're over, and bull markets last for years, sometimes, 7 to 10. So let's talk about that from the perspective. Let's get into Open Door a little bit. You've talked at it ad nauseum. I'm sure you're tired of it. So let's go at it from a different angle. If we had to put together a short thesis, what would it be? I like to do this on the other side when I have high conviction. One of the knocks that I've heard from someone else that's like, I just don't love it, is that people don't want to sell or buy a house sight unseen, right? Like, is that really a market? Is an app really going to change? And I remember this coming up when virtual reality was first coming out, that it would disrupt the real estate market. How would you respond to that thing about just because you can put real estate on an app doesn't mean it's going to change the market? What would be your counter argument to that?
I think I would just say that, the one truth is that we seem to be more and more antisocial as time goes on and want to live looking at our phones like this. And so just like there might have been people that didn't think you would want to stop calling the local cab company to order your cab and just do it on your phone, or buy a car through Carvana, as opposed to going to see Charlie, at your used car dealership and haggling over the price of your that you're going to pay for a new car. We've seen that more and more we want to go in this direction of one click, impersonal, do it through the app and all that. So I think even though it might, shock a Gen Xer like me that somebody doesn't want to touch and look and feel, you got to remember, I'm kind of approaching grandpahood here.
I know, man.
An older
you and I
way
both.
Of yeah. So, if I was going to build a short case against Open, I probably would point to, the risks of higher for longer, the macro going against the housing market, inflation being stickier than expected, like has been in the UK. And therefore, that's going to be a drag on Open because, they, along with others in the housing space, as the rates come down, it's like a magic elixir, and the volumes will increase, the refis will increase, the housing activity will increase, and that's going to be good for an Open. But what if that doesn't happen, and how can they manage through that? I don't know. Now the short thesis saying, they have bad management, that's gone. They have great
that's
management.
Gone. Yep.
You could maybe say that, I don't know, the morale is going to be hurt because Keith Raboy has talked about laying off 80-90% of the company. And so what are they accomplishing?
But here's the thing. Look at the Mag 7, right? 2 years ago, they went through some pretty hefty layoffs, and it unlocked that profit growth for them and the revenue growth. So you make a good point, though. The short thesis really is hinged on macro points that might not go in the company's favor. But when we look at the micro from the bottom up fundamentals, Anthony Pompliano called this the greatest activism campaign, I think, ever in the stock market's history that you catalyzed and really are the leader of it. You've changed the CEO. You've changed, new CEO, new board. What do you think is next, right? I mean, that all happened in 10 weeks. What are the fundamental things that you see changing that Opendoor can do that really unlocks even more value to get to your price target at 82 and beyond quicker?
Well, I guess one of the big bear theses against Opendoor has been iBuying has never worked, and it never will work, and that's why Zillow and Redfin got out of it. And Keith Raboy and Eric Wu, they're not that smart because they were involved in this company for 10 years in version 1, and they failed at it, and therefore they will fail again. So it's basically sort of saying that if I had to summarize, it's sort of a lazy person analysis that would say Apple will never work because Steve Jobs tried it once and he failed, and then they brought in the hotshot John Scully and he failed. So they should just, like, at that point, they should have just put it in boxes and got home and called it quits. That's the short thesis, or that was the short thesis. So iBuying, like, itself doesn't make a lot of money. It's not as profitable as Carvana is selling cars. It's a bigger price point, and therefore the gross profits are smaller. But I've sat with Keith, and I spent an hour with him in Soho a couple of weeks ago, and met him for the first time. And he spelled out in some of his. I think he had a tweet in mid-August where he sort of gave his new strategy, which was layoffs. It was like focus on AI. It was like exploding the sellers and buyers that are on the platform. And it's truly like the original vision for Opendoor was the Amazon of housing, which sort of means this, like, disrupt the agents. Opendoor had been like trying to play footsie with the agents and say, hey, we can be friendly with the agents. We can split fees with the agents. Right. That's going to go away with Keith Raboy. I can assure you. He wants to blow the agents out of the water. He wants to have this like pure, like, one click selling your house, and maybe at one click at the same time as you're selling your house. Oh, and would you like to be offered a line of credit to go buy your house? Go buy another house. Yeah. Right with us. Yeah. Yeah. Buy it. So that he wants to like totally transform it. And I think he's energized by it. I don't think he was expecting this like open army thing to kind of pop out of nowhere. But like, I don't know all of his private companies that he has in his portfolio, but I really think like this is the most exciting opportunity that he has on his plate right now. And I think feels like a sense of redemption because he wrote the business plan for it. And I think he feels, and Eric feels, a sense of, hey, we've been given a second chance at life here, and we're not going to screw this up. We're going to actually fulfill the original mission for this company. And we have a great CEO now in Kaz to do it.
I think that's a great assessment too. It's like Steve Jobs coming back, right, to their baby. They're going to figure it out, get it resurrected and moving in, multiples higher. One of the things that I think is super interesting in the wake of trying to find a new CEO, they started communicating, which you advocated for early, communicating with retail investors, self-directed investors, to now where they have an entire website. I mean, I think they tweeted it out where it's the community website. You can follow the QR code on the screen to check it out. I think this is going to change the way most public companies now communicate with investors. What are your thoughts about it? Do you see this as kind of a precedent setter where the IRENs of the world, Ciphers, and other companies are going to follow suit and start having more transparent communications, especially in light of the president calling for semi-annual reporting now instead of quarterly reporting?
I think you're right. I think it's not the reason why they didn't do it before was the prior management was like it was kind of like a generational thing. They had no idea how to do that. They didn't think that was part of their job that they had to cultivate. I think President Trump getting elected was kind of a watershed moment, not just for business, but like in the sense that here's a guy who could go on a 2-hour podcast and just hold his own and just come across as a real person, authentic. That's the word I always hear. Authenticity, right? And Kamala was seen as this stage-crafted, nervous person, inhuman, inauthentic, incapable of speaking, not a real person. Nobody agreed 100% with everything Trump said, but they just sort of felt like, this guy's a real guy. And he's telling you what he's going to do. I mean, he's being honest and authentic about it, right? I think, and now I think people expect the same from their podcasters, from their CEOs, from their whatever, hedge fund guys, guys like me. They gravitate to that. And so, I mean, I hear that all the time. I mean, I get obviously I get lots of criticism. What an idiot, like I can't believe, you have no self shame, standing in front of Drake's house. I can't believe CNBC ever let you on the air.
Yeah, but look, dude, but here's the thing. Anyone that's done something great in the world always ignored that nonsense. You have to do something different. And I think what I love about you is that you're taking the trolls in stride and just saying, hey, this is what I did. I mean, your son came up with that idea to stand outside Drake's house, wasn't it? So like, as a dad, you're going, hey, my son's smarter than all you other idiots out there that haven't had an original thought in a decade. Like, I'm leaning in on my son, right? So how do you...
Yeah, I mean, I'm old, I've been around, I made mistakes. And like, I don't know, like the way it started was like some guy who I'd never heard of contacted me on TikTok. And he said, I want to do a TikTok live interview with you. And I didn't know who this guy was. I'd never heard of him. And I sort of had to pass it off to my son. And I said, Julian, should I waste my time with this guy? Or is it going to make me look bad if I do a TikTok interview? And he like in a couple of seconds, he like pulled up the guy's profile. And he said, no, this guy's legit, Dad. You should definitely do this. You should definitely. Okay.
So, dude, I love your willingness to adopt and adapt in a new society, right? Like things totally have changed digitally where, you and I grew up in this traditional Wall Street world where it was just siloed off, no exposure. So I give you kudos for that. I also want to, we have the chart. I think we can bring it up of your performance too. Here's one other thing. Look, I think there's a lot of people that are riding your coattails because you're a super generous guy and you share your research. I'm sure you're always getting asked, like, what's your next stock pick that's going to go up, your 1,000% winner? I'm not going to ask you that. Instead, I'm going to tell you, like, look at this impressive performance that you're stringing together. You're honest. You've had mistakes. We all have in this world. But I want to encourage people that are accredited investors looking to invest in your hedge fund to reach out to you, because the best way to get your next stock pick is to be one of your clients. You're going to get it before you put it out anywhere else, right? Am I wrong? Or are you going to tell the world before you position it for your clients?
No, I mean, of course. I mean, I work for my investors. That's exactly how I make money. That's how I support my family. And so, yeah, I appreciate that. And I've been really like, it's so fortunate. Like so many great people have reached out just in the last few weeks and said, hey, I want to invest. And I've got, there's money kind of that has come in, that will come in, and I'm really grateful for that. I mean, but I do think it's important to kind of share. Like, I do have a new idea. I'll share this with you, Lou, and I'm going to announce it next week. I might announce it as early as Monday. And I've been working on this thing for months. I'm really excited about it. I think it's a great opportunity. But I've been on a hot streak, but I've also been on a cold streak too. And I know that you're only as good as your last idea. And yes. I know if I lay an egg, with this idea on Monday, then people will stop paying attention to me. And they'll say, this guy just got lucky with Open Door, forget it, and I'm out of here. I'm not going to pay any attention to Eric. So, I mean, I have to keep coming up with good ideas. I think I have a good idea. I think I had a lot of people around me saying, not my son, but I had people saying, you need to monetize this. You now you have all these people that invest in your fund. You have a lot of retail support, and you should start a paid newsletter, and you monetize that. That's the way you do it, Eric. And you could make I don't know, millions or something. And it all depends on how many people sign up for it. And I went to my boys. I have my two boys, my 16-year-old, and then I have a 20-year-old. And I said, "What do you think about this, guys?" And then they said, "Dad, no, they'll roast you on Twitter, Dad, if you do that. They'll roast you. You can't do that." I mean, so I would rather sort of just share it on Twitter. People will make money from it. I mean, if they agree, and maybe they won't, and then maybe they won't buy it. But if they buy it and it does go up the way that Open did, they'll do well. I won't participate in that, but I feel like there'll be enough people that are going to pay it forward. Help me out in other ways, or invest with me in other ways that, that's what I care about. And it's been so rewarding, Lou, like just get all the DMs I get, like every day, DMs from people who've made so much, money from Open Door to this point. And I think there's still, big upside to go. And they say, you can't believe you've changed my life, and we've paid off credit card debt or student debt or this and that, thank you so much. And that's priceless, right? Like if all that money was in your fund and you made an extra $10 million, it doesn't have that same reward, because it's changed your life, but it hasn't, or to some degree, but it hasn't changed all those people's lives. So I think, look, I'm going to encourage you. I came out of the newsletter world where I charge for subscriptions. I worked in it for 15 years. Yes, it can be wildly successful and profitable, and you can change people's lives. But like you said, you're only as good as your last pick.
When you pick some stinkers like I have in the past, and you got 100,000 followers, you know what it leads to. It's a lot of headache. So I think I would encourage you, keep with your abundance philosophy of just sharing it. That's what we're trying to do here. And let's change as many people's lives as we can by coming up with some really good ideas instead of siloing it off and keeping it to ourselves.
Okay. Yeah.
Yeah.
I totally agree.
Well, listen, and we always appreciate your willingness to come on and share your latest thoughts. I can't wait to see what your next new idea is. And everyone listening, I want to encourage, if you're not following Eric, you're missing out. You are more prolific than anyone, but you also give great insights. Make sure you're following him right now, Eric Jackson on X, so you can get his next possibly 100,000 bagger. I want to thank you for getting me involved in Open, my friend, around 2, and IREN around 19. I'm benefiting because of you and your willingness to share. So please keep doing what you're doing, man. We appreciate you.
Thanks, Lou.
All right, you heard it right from the man himself that's got the hottest hand in the markets. I mean, forget Warren Buffett and Ackman and any of those players. They can't keep up with Eric Jackson right now. And I'm equally excited for his newest recommendation. So I will tell you what, we'll make a deal that we'll cover it in the next episode of The Big Skinny. I'll do my work on it once I see what it is, and I'll give you my take on it and tell you whether I'm buying or not. And I'm going to tell you, based on his performance, I'm most likely going to be buying. But hold that thought. We'll be right back. We're going to talk to you about some of the other key tenets that we hold here in our manifesto at The Big Skinny, and then we'll get to some stock picks too.
Where we can bring on more power capacity.
And is that how you find those opportunities, maybe those offshoots of AI, not the Mag 7 players, but what are those opportunities where maybe you can get in early and we could see some of that significant
Yeah,
rally?
maybe some individual stocks or sectors, how you see it
Absolutely.
play.
So I always look at, like, pick and shovel plays are a great way to play a new trend. NVIDIA was the ultimate pick and shovel play, but now you have to think of first derivatives, right? Who else is doing something that's essential? So that brings in names on the power side. I mentioned the Bitcoin miners that are pivoting to providing the compute. It brings in names like Core Scientific, which was acquired by CoreWeave. So CoreWeave's the household name in the space, but they also have a ton of leverage on their balance sheet. So maybe not so attractive from an individual investment standpoint. But in that same class, you have TeraWulf, W-U-L-F. And I own all these, so full disclaimer, because this I see as the next leg of this trend. IREN, which is another Bitcoin miner that's pivoting, and then Cipher mining. So those are 3 opportunities that you can play this power supply struggle, and you're seeing the likes of Alphabet and Google do deals with TeraWulf to secure power. So I think you're going to see more in those types of deals unfold as the year goes on. And that's really re-rating these stocks because they've been pinned based upon Bitcoin prices, right? How much Bitcoin can they mine? What's their hash rate?
And then you got the halvening, the rewards kind of decrease over time. So that
exactly. So now you're changing the model, almost like we changed the model for Apple. Remember, it always traded at a lower forward multiple because it was just a hardware company. And then when services revenue breached and hit an inflection point, it jumped, and now it trades at 27, 28 times forward earnings. So you're seeing that same re-rating and applying a new valuation model to these Bitcoin miners that are pivoting to HPC. So I think that's one of the best opportunities in the market right now. I'm personally over-levered there, overexposed. So either I'm wrong and sorry, or right and happy. And I think ultimately this trend plays out favorably for that.
All right, here at The Big Skinny, welcome back. We've told you that we have a manifesto of how we operate. You may not have seen it on our website, so we're going to go through it so you just know what we're all about. You know, Wall Street's old playbook doesn't work anymore. It just doesn't. It worked for Wall Street, but it doesn't work for Main Street, and that's what we're all about. Flipping the script, causing a spasm on their part, because we're going to share all the details and information that makes you money. So we've got 7 points, key points in our manifesto about how we operate and what guides us. Let's get to the first one, and it's simply this. We shoot straight, folks. We don't dance around the point. We punch it square in the mouth, all filling, zero fluff. That means no fancy jargon or 12-paragraph, I don't know, diatribes to let you know what's happening next. We just say the market's down. Folks, we just prefer to translate Wall Street gobbledygook into English quickly and then send you on your way. So that's the first thing we do. We shoot straight, folks. And then the other thing is we rely on data, not people, right? Because people can lie. The data doesn't have agenda. Not to mention plenty of brilliant people have blown up portfolios. That's why we go straight to the data. We figure out what the numbers actually mean and how to profit from it. Or more simply, we don't worship IQ, we worship ROI. What's the third point? Well, it's related to this too. We're here to make money, not to fit in. Folks, we're not in this for the likes, retweets, or the pats on the back from Wall Street. We're here to increase our bottom line, period. And if we're not helping our viewers and ourselves build wealth, then what the heck are we busy doing? That's why we don't follow the herd or bow to the norms, or as I always like to say, as Humphrey B. Neal said, when everyone thinks alike, everyone is likely wrong, and you don't make money when you're wrong. So that's right. We're here to make money and not to fit in. But I also say this, and I think this is one manifesto point that you know well. We're humble. We're here to be humble. Otherwise, we know we're going to be humbled again. Look, the market doesn't care who you are. The second you get cocky, it hands you your head on a silver platter. We've been there. Lesson learned, t-shirt earned. That's why we're constantly curious and all too happy to change our mind when we realize we're wrong before our portfolios get burned. And a key part of this piece of our manifesto is to bring on way smarter people than us. We know we're not the smartest person in the room or on a topic or a particular stock. We've shown that. Eric Jackson collectively has put more hours into researching Open Door, and Mike Alfred, IREN, why not benefit from their intelligence and expertise? What do we also believe? We believe dumb money isn't so dumb, folks. Don't believe the press clippings saying that you're not that smart. Retail investors aren't just in the game. We are the game now. On any given day, we're going to make up over 30%, sometimes almost 40% of trading volumes. That's roughly triple the long-term average. And look, we've shown we can move markets, outsmart institutions, and rewrite the rules Wall Street thought were written in stone. To this, I say welcome to the revolution, not the dumb money revolution, not the retail revolution, the self-directed revolution. And we aim to be a direct part and contributor in that. We're not old school, we're new school, folks, bridging that transition to where retail has a voice and an impact that everyone underestimated. So what else do we believe? Well, we believe we're funny and not fake, right? We just don't want to use jokes, memes, and irreverence and, just make you think we're just goofing around. This isn't amateur hour. We've been in boardrooms, on trading desks, and in the trenches on Wall Street. But humor is just a good way to take the edge off. Why take ourselves so seriously? I mean, I make flubs and blunders all over the place on these episodes. Sometimes we're live streaming. Instead of being completely polished in a teleprompter, I'd rather come to you as a human and have fun doing it. And we have fun together. So look, it's a core part of who we are. More importantly, well, we're generalists, opportunists, and optimists. We cast a wide net. We don't over-specialize. It's not because we're not focused. It's because over-specialization breeds overconfidence, the kind that blows up portfolios and forces us to miss opportunities. We'd rather connect the dots across sectors to find opportunity wherever it hides. We stay optimistic because history favors the upside. And well, I got to be honest, remember Saturday Night Live? Being a Debbie Downer is no fun for anyone. So why be depressed and predicting the end of the stock market and the end of civilization? Folks, that's not what we're about. We'd rather find the pocket of opportunity, even in the darkest hours, because, well, the long-term chart is up and to the right, and we want to be right and on the right side of that for our portfolios. Well, that rounds out the manifesto of things we believe. We hope, look, what do you believe? Chime in, email us at info@thebigskinny and let us know. We're going to be coming back right after a quick break to handle this week's top 5 updates, including maybe a stock pick or two on things we've spoken about on previous episodes of The Big Skinny. So we'll be right back. Remember last month we introduced a new segment called the Young Entrepreneur Spotlight, and we featured Kennedy Joy Forrestal, founder and CEO of Raid. It's a peer-to-peer clothing rental app that is taking literally college campuses by storm nationwide. They're rolling out to over 20 locations now. If you missed that interview, scan the QR code on our screen and check it out. Kennedy Joy, I'm telling you, is an amazing young CEO that is destined and already doing great things. Keeping with the spirit of wanting to give back and invest in the young guns that are shaping our future, we'd love to feature more young dreamers and doers on future episodes, and that's where you come in. Do you know someone young building something bold, smart, or just plain scrappy? We want to hear from you. It doesn't have to be tech related. Just want to know, is there someone else that we can give a helping hand along the way by giving them some exposure? So please, by all means, check out what Kennedy Joy is up to at Raid if you missed that interview. It'll also give you a flavor for the types of individuals we're looking for. And if it happens to be your son, your daughter, your granddaughter, your grandson, or someone in your family or immediate network of friends, we want to hear from you. So email us at info@thebigskinny with just an introduction, and we'll take care of it from there and get them featured on the Big Skinny and hopefully help them along the way on their mission to take over whatever market it is and whatever dream they're pursuing. So folks, that's what we're all about here, giving back. And now we got to give back to and welcome in Mr. Dodd, because this is the time of the show. How you doing, my friend?
Doing great, Lou. That was a great interview with Eric Jackson. I really love how down to earth he is and how just direct and very, personable. That goes without obviously saying all the, his advisement in his stock picks, of course, but just from a personal level.
Yeah. It gives me great just hope in humanity, because that guy could be so arrogant right now. He could be like the LeBron James, just like, I'm the best. I'm going to have a press conference to just tell you what my next pick is because I'm so awesome. Instead, he's just like, hey, man, I'm going to go to an amusement park with my kids this weekend. And like, I've changed people's lives just by research, just by sharing it. And I'm going to keep doing that. So I love that. Would we be saying the same things if he didn't have 3 mega winners? No, but here's what I know about that. He's had that success, and the true person is coming out, right? It just amplifies who he is. So I thought it was awesome to just hear directly from him. And man, I hope
he's honest about knowing, the next one, he's saying it now, not everyone's going to be a winner, but he's being honest about it and giving you his, all his best. And, just like, we've done in the past as well. So,
yeah, no, I think it was great. It's always great to have him on. All right. So now, since he was so reflective and humble, I think we've got to make sure we're humble. This is the time of the show where we look at things that we've predicted, said was going to happen. We kind of level set and see if we were right, wrong, or maybe haven't figured it out yet. I mean, we were wrong about small caps, just like Eric for a while. So you ready to get to the high five?
Let's do it.
All right, man. Dan the man here just said Lucky Louie and 2, you in a 2 box with me, man. They got all the funny ones. No dongling around here with the lame stuff.
Yeah. Well, okay. First one, tariff math. So I have 3 daughters, and I know girl
God
math.
bless you. God bless you.
Thank you. I need all the blessings I can get. But help me understand why tariffs that so many predicted would be dramatically increased prices haven't done so yet.
Yeah, it's funny. Everyone freaked out, right? If you looked at when the tariff press conferences came out, even like consumer spending froze a little bit after that. And you just kind of heard it on Main Street are the prices of eggs going to soar again? If you look at it, and here's the interesting thing. If you look at how companies make money and how the economy grows, right? Is it goods or services? So tariffs impact goods, not services. And if you look at this, the S&P 500, over half of their profits are coming from services, right? So that mutes the impact of the tariffs if it's not 100%. And then if you look at GDP, 72% is from services, so only 16% is coming from goods. So really the tariff impact has been just watered down, for lack of a better term, right? Like it's just not impacting the businesses as much as people would anticipate because it's only a smaller portion. It wasn't 100%. So I'm here to say, thankfully, look, tariffs are going to have some impact, but they're not going to be this catastrophic increase in reinflation like we saw under the Biden era at 9.1% when a dozen eggs were going for north of $10.
Well, you bring up a great point. You brought up eggs again.
Just one great point? Just one.
Well, you brought up several great points, of course, Lou, but you brought up eggs. And we haven't checked in weeks about the prices of eggs in New York. So where are we sitting now? They were at $10 a dozen. Are we still high?
Dude,
any idea? Have you bought eggs?
You're the intern.
Recently?
You're supposed to. Oh, that's right. We promoted you. I can't make you look up egg prices in New York. I have no clue where they are. We don't actually go buy them. We just push a button and they're ordered and delivered to our house. So I'd have to ask
Florida
my
egg
wife.
prices have come down a lot. I'm just, I didn't know if the city is still kicking them at $10 a dozen.
Well, if Mamdani gets elected, they're going to go north of 10 and back to 20. So we'll see what happens. I'm not going to wage a prediction on that. Let's not go into politics. Let's stay quickly into the markets. What else you got for me on the markets?
All right. AI ain't over. So last week you had mentioned that The Economist was, saying that the AI whole boom and trend is already over, and yet you're still bullish on AI. I think I understand why, but can you explain exactly why?
No, look, I think we said it in our manifesto. We focus on data, not people, right? I don't care what some futurist predicts might happen. I care what the data says. And all things like we've talked about CapEx spending on AI, the amount that just the mega caps are spending. But here's the latest data. People are using it, right? This is monthly web visits to different AI platforms. Now, ChatGPT is off the charts leader here at over 6 billion right now. But if you look across, I mean, from Gemini, DeepSeek to Grok and Copilot, Perplexity, these charts are all the same, right? They're up and to the right, and dramatically so. So this tells me that people aren't just building the field of AI dreams and no team's going to come. Like, the players are here. They're on the field, they're playing, and they're asking for more and more applications and ways to use this. So yeah, AI ain't over, and that ain't the last time I'm going to use slang, even though I was an English major. So keep your hate mail to yourself.
Ain't a word.
Ain't a word, ain't it?
All right. Speaking of words, I see the R word up there again. So I'm going to, I know we're talking about recession. So, last week we discussed that CEOs pretty much stopped mentioning recession in their conference calls. With the job markets getting way worse, shouldn't we start worrying about recession again?
No, it's great, right? That's the counterbalance, is that you'd think if the labor market's weakening, which it is, and we featured that last week, that would be a sign the economy is going to roll over. But here's a great data point to show that's not the case. Most recessions happen as profit margins are declining. And if you look at this chart here on the left, that green line that is coming down, from the top left coming down, that's the typical profit margin performance as we head into a recession at 0 quarters. But what you're seeing, the red line, is now the profit margin's actually been increasing. And then you can see that on the right. The right is just playing that out more specifically. S&P 500 profit margins are now at almost 13%. That is not the recipe for a recession. When the margins dip down, that's when businesses have to make tough decisions, right? Do you have to make more layoffs? Do you have to change your product mix? Are you going to be unprofitable and go out of business? So yeah, I'm happy to say the R word that is being thrown around still occasionally in the financial media of a recession is just not relevant, to keep it in the R family, right? I wrote that op-ed I wrote was in July of 2023, saying there's absolutely no recession imminent. We had it in 2022 in Q1 and Q2. But look, I'm here to say that the GDP growth numbers are only getting better from here, not worse.
All right. Well, let's hope that's 100% true. All right, hedgy hate. I thought hedge funds were supposed to be the smartest investors in the market. Eric
Jackson is a hedge fund manager that is smart in the market, but yeah.
If this small cap rally is most likely to continue for years, why are they so short?
Yeah, look, we showed that chart, like the notional value, 17 billion, but we showed this one before, right? Small cap haterade. I wonder what's going to happen here. Like, if you look at this, the blue line going down is how much their short bets are increasing, and yet the orange line is what's happening with the prices. So as they're betting against small caps, the small cap index was actually rallying, so putting them in a really precarious situation that they're wrong. And eventually, the way shorting works is when you bet against something and it moves higher, you have to go back into the market and buy back that asset, which drives prices even higher. It's known as a short squeeze. So there's a lot of institutions that are caught offsides in the small cap rally that now we just broke out the fresh all-time highs, which breaks through a technical resistance level. They're going to have to come back and unwind those short bets and buy into this rally, which just gives me the confidence this thing's going to last. It's not going to be a flash in the pan small cap rally. What's next? The next leg is going to pick up with micro caps even more. So,
well, let's definitely hope that is the case. I've been waiting for that for a long time too.
You and I both, my friend.
Exactly. Endless Summer. First of all, do you remember what this one is? This is number 5.
It is number 5, and I do remember it's not that movie of yesteryear about the endless summer, but it is about surfing. As people have probably figured out, this episode is not live because I'm, by the time watching this, going to be surfing with my son, searching for an endless summer here with our good friend Uri Roca down in Nicaragua. I'll also be visiting the Roberto Clemente Clinic, and hopefully, if I'm lucky, this is the only time I'm going to show off, because hopefully it probably will never happen again, because it scared the daylights out of me, is I'll catch a big wave. We didn't think anyone saw this. This is the biggest wave I've ever caught in my life. No, I did not get smashed and crushed into the wave here. I rode it out and came to the backside and actually got to see my son, and his face was like, Dad, that was a huge wave. So yeah, here's to smaller, more fun waves that I'll be riding while everyone's watching this and getting the insights from Eric Jackson. So
and
don't
I didn't
be jealous.
even Photoshop that one for you.
I know, man. People are going to think you did Photoshop me into that you pulled out Kelly Slater and threw Lou Basenese in there. But
no. Can anybody tell that's really you? Are you sure that's you?
Oh,
zoom way in on that.
I'm facing the wrong way. You can't see the tattoos on the inside of my
arm.
How
convenient.
So, yeah, I know. But now, listen, I'm excited to be down there to check in on the clinic to see what else is going on, to maybe catch a wave like this. I mean, look, that's a short guy. You're the big, I'm the short. So that wave's really only 2.5 feet tall. It's anyway.
That looks like mini me on a surfboard.
Yeah, I knew you were going there. I'm here. Self-deprecation, even still, doesn't ward off you guys making fun of me. But how'd I do? Speaking of making fun of me, oh my goodness, the Mario Brothers. All right, can you give me the mushroom that makes me grow? That's what I want to know.
Here we go!
All right, we play a game. I know we're having fun and goofing here. How'd I do in this week's game?
The way I counted, I think you had 4 of the 5 today. I think you missed one.
What did I miss?
No. Dongle.
No, man, I got it.
Did you get dongle? I missed dongle.
Dude.
Where was dongle?
I got it at the end, right at the end, dude. Come on now.
All right. We'll have to go back and play back the tape, because I'm not sure about that one. See,
and here's the encouragement, right? These words came in this week from a fellow and faithful watcher and friend, Dave M. So if anyone else has words you want me to try and work into the conversation, email them to Dodd, D-O-D-D, not the Department of Defense, but add an extra D, D-O-D-D @thebigskinny.com, and he'll put them on the list. I get them about 30 minutes before showtime and try and work them in naturally and not make it awkward. So no one's looked and said, what the heck are you talking about yet? But maybe they are.
Not yet.
Not yet. Well, listen, man, until next week, we actually have a fundamental versus technical analysis kind of debate teed up for next week. We talked about energy. That's coming on October 6th. We're going to delve into that contrarian, unloved sector of the market with an expert in the space, as well as the CEO of Prairie Operating Company, my boss. And we've got a few other surprises along the way. So please tune in to the next episode of The Big Skinny. Make sure you find out about it by subscribing to our YouTube channel. We're trying to catch Mr. Beast. Maybe it'll happen before my 80th birthday, but we're going to try and close that gap as much as possible. If you subscribe on our YouTube channel by scanning the QR code on the screen, you'll get notified right before every episode. And if you're not following us there, subscribe there. Follow us on X. We put out a lot of updates and information throughout the market week, just our interpretations of the headlines. Do they matter? Do they not? And what's going on with stocks? So with that being said, I want to wish everyone a great week while I'm away on a partial vacation. And we'll be back right here September 29th, bringing you the next episode of The Big Skinny with Lou Basenese, thanking the team and every one of you for always being faithful listeners and tuning in. We're out.